November 22, 1910. A private train car slips out of Hoboken, New Jersey at 10 p.m. 7 men aboard, no reporters allowed, no names given. The conductor was told only that his passengers were going duck hunting at Jekyll Island, Georgia. But these weren't hunters. They represented 1/4 of the world's wealth, and over the next 10 days, they would design a system that controls your money right now. Today, the Federal Reserve they created holds $7.7 trillion in assets. Every dollar in your wallet, every price you pay, every interest rate on your debt traces back to what these 7 men built in secret. They weren't elected. You didn't vote for this. But that meeting changed money forever. What they created wasn't a conspiracy theory. It's documented history. And by the end of this video, you'll understand exactly how a secret meeting between bankers became the law that controls your financial life. If you want to understand where your money actually comes from and who really controls it, hit that like button and subscribe. October 1907, New York City is dying financially. The Knickerbocker Trust Company, holding $60 million in deposits, collapses on October 22nd. Lines of desperate depositors stretch around blocks. Within hours, 12 other banks face runs. People are literally fighting to withdraw their savings. The stock market loses half its value in 3 weeks. But here's what made 1907 different from every previous panic. There was no central bank, no federal safety net, no one to stop the bleeding. The crisis started with copper. Augustus Heinze tried to corner the copper market. When his scheme collapsed, it took down his bank, then his brokers, then the trust companies connected to them. Trust companies were basically shadow banks. They held deposits like banks, but could speculate more freely. They'd over-leverage themselves by 10 to 1. When depositors wanted cash, the trusts didn't have it. America was on the gold standard. Every dollar had to be backed by gold in a vault somewhere. When trust companies failed, they couldn't print money to save themselves. They just died. And they took their depositors' savings with them. 9,000 people lost everything at Knickerbocker alone. That's $60 million at our 1907 money, about $2 billion today, just gone. JPMorgan, the most powerful banker in America, locked 13 bank presidents in his library on November 2nd. He was 70 years old, chain-smoking cigars, playing solitaire, while bankers screamed at each other in the next room. By 4 a.m., he'd forced them to pledge their own money to stop the panic. Morgan personally saved the financial system, one man, because no institution existed to do it. The crisis revealed a catastrophic structural weakness. Without a central bank, the entire American economy depended on whether one private banker felt like saving it. What if Morgan had died in 1906? What if he decided to let it burn? The gold standard was supposed to create stability. Instead, it made the money supply rigid exactly when flexibility was needed. When people panicked and withdrew gold, banks couldn't create more money to meet withdrawals. The system just seized up like an engine without oil. European countries had central banks. The Bank of England could inject liquidity during panics. The German Reichsbank could expand currency when the economy needed it. America had nothing. Just Morgan and his checkbook. Politicians, businessmen, even ordinary people realized something had to change. The system was too fragile. But here's the problem. Americans hated central banks. Thomas Jefferson had killed the first attempt. Andrew Jackson had destroyed the second one. Populist politicians like William Jennings Bryan spent careers warning that bankers would enslave farmers with centralized money control. So when the crisis ended and discussions about creating a central bank began, everyone knew any solution would face massive political opposition. The question wasn't whether America needed a central bank. After 1907, that was obvious. The question was how to design one that Americans would actually accept. And that's where Paul Warburg enters the story. Because he'd been warning this crisis was coming, and he already knew exactly how to fix it. Paul Warburg stepped off a ship in New York Harbor in 1902. He was 34 years old, German-born, and he couldn't believe how primitive American banking was. Warburg came from the Warburg & Carnard banking dynasty in Hamburg. His family had financed European governments for generations. He'd married Nina Loeb, daughter of Solomon Loeb, which made him a partner at Kuhn, Loeb and Coors, one of Wall Street's most powerful firms. But what shocked him most was that America had no central bank. In Germany, the Reichsbank coordinated the entire financial system. It could expand credit during growth periods and contract it during speculation. It acted as lender of last resort when banks faced temporary liquidity problems. The system wasn't perfect, but it didn't have the violent boom-bust cycles that destroyed American banks every 20 years. Warburg saw 1907 coming. He'd been writing articles since 1906, warning that American banking was a disaster waiting to happen. When the Knickerbocker collapsed, he wasn't surprised. He was prepared. Between 1907 and 1910, Warburg became America's loudest advocate for a central bank. He gave speeches. He published detailed proposals in banking journals. He explained the European model to anyone who would listen. His plan was sophisticated: regional reserve banks to prevent New York from controlling everything, a central board to coordinate policy, the ability to create elastic currency, meaning the money supply could expand and contract with the economy's needs rather than being fixed to gold reserves. It made perfect sense to bankers, but it terrified everyone else. William Jennings Bryan, the populist hero who'd run for president 3 times, called central banking a plot to enslave farmers. He'd spent his career fighting the gold standard and Wall Street control of money. The idea that bankers would legally control currency creation seemed like his worst nightmare coming true. Warburg's European sophistication worked against him. Americans suspected foreign bankers wanted to impose European-style control over American freedom. Here's what Warburg understood that his opponents didn't. The crisis of 1907 proved that somebody was going to control the money supply. It would either be organized and systematic through a central bank, or chaotic and arbitrary through whoever happened to be the richest banker when panic hit. Warburg genuinely believed a central bank would create stability and prevent the kind of destruction he'd watched in 1907. But he also understood it would be fantastically profitable. Central banks made money by managing money. They collected interest on government bonds. They charged fees for services. The Bank of England's shareholders had been collecting dividends for 200 years. So Warburg had motivation beyond public service. A properly designed central bank would generate steady profits for its member banks while appearing to serve the public good. But he couldn't get his plan through Congress. Too much opposition, too much populist anger. Americans would never vote for something called the Warburg Plan, written by a German immigrant banker. He needed political power. He needed someone Americans trusted. And in 1910, he found him. Senator Nelson Aldrich, the second most powerful man in America. And he was ready to make a deal. Nelson Aldrich was everything Warburg wasn't. American-born, politically connected, trusted by the establishment. He had been a senator from Rhode Island for 30 years. He chaired the Senate Finance Committee, which meant he controlled every piece of financial legislation. And he had one more advantage. His daughter had married John D. Rockefeller, Jr., making Aldrich family to the richest man in America. When Aldrich spoke about banking, politicians listened. After 1907, Congress created the National Monetary Commission and put Aldrich in charge. His job was to study banking systems worldwide and recommend reforms. He spent 2 years touring Europe with Warburg as his guide, studying central banks. By 1910, Aldrich was convinced America needed one too. But he faced the same problem as Warburg. How do you create a central bank in a country that hates central banks? The answer was secrecy. November 22, 1910. Aldrich sent word to 6 men, meet him at the Hoboken train station. Tell no one, use only first names. The 6 who came represented American banking royalty. Paul Warburg from Kuhn, Loeb. Frank Vanderlip, president of National City Bank, the largest bank in America. Henry Davison, senior partner at JPMorgan. Charles Norton from First National Bank of New York. Benjamin Strong from Bankers Trust, and Arthur Shelton, Aldrich's personal secretary, to take notes. Their destination was the Jekyll Island Club off the Georgia coast. The club was owned by the country's richest families, Morgan, Rockefeller, Vanderbilt. It was completely private, no reporters, no staff except those who could be trusted. The 7 men arrived and immediately went to work. They spent 10 days locked in the clubhouse, using only first names to preserve secrecy. Even the club's staff was dismissed during their most sensitive discussions. What they built was the Aldrich Plan, the blueprint for what would become the Federal Reserve. 12 regional reserve banks spread across the country, not just concentrated in New York. This was crucial for political acceptance because it made the system seem decentralized. A central board in Washington to coordinate the 12 banks, the ability to create elastic currency by buying and selling government bonds, which would let the money supply expand during growth and contract during bubbles. Member banks would own stock in their regional Federal Reserve Bank and collect dividends. It was elegant. It balanced regional independence with central coordination. It gave banks control while appearing to serve public interest. But here's what made Jekyll Island necessary. If Warburg and these bankers had designed this openly, populists would have destroyed it. The plan needed to appear as if politicians created it, not bankers. That's why Aldrich was essential. He could present this as the National Monetary Commission's recommendation, not as something drafted by the exact bankers who would profit from it. They kept the meeting secret. For years, some participants denied it even happened. Vanderlip didn't admit the truth until 1935, but they'd done it. They'd created the blueprint for a central bank that could actually pass Congress. There was just one problem. Americans still hated the idea, and they especially hated Nelson Aldrich. January 1912. Aldrich introduced his plan to Congress. It died immediately. Democrats had won control of Congress in 1910, and they despised everything Aldrich represented. He was the face of Republican establishment power, the son-in-law of Rockefeller, the symbol of Wall Street control. His name on the legislation guaranteed its failure. Even worse, Woodrow Wilson won the presidency in 1912 by running against exactly this kind of banking consolidation. Wilson had campaigned on breaking up monopolies and limiting Wall Street power. The Aldrich Plan was dead, but the plan itself was too good to abandon. The bankers who designed it at Jekyll Island knew it worked. They just needed different packaging. Enter Carter Glass, a Virginia congressman who chaired the House Banking Committee. Glass was a Democrat, a populist, and he publicly hated the Aldrich Plan. But privately, he was convinced America needed a central bank. Louis Brandeis, Wilson's trusted advisor and a genuine populist reformer, helped Glass understand the economics. They brought in Robert Owen, a senator from Oklahoma, to champion it in the Senate. The rebranding was brilliant. The Aldrich Plan became the Federal Reserve Act. Instead of Aldrich's name, it carried Glass and Owen's names. Instead of emphasizing banker control, it emphasized government oversight. The central board would be appointed by the president, not elected by banks. The system would be called Federal Reserve, not National Reserve or Central Bank. The word federal made it sound governmental, even though the 12 regional banks would still be owned by private member banks. Wilson, who'd campaigned against central banking, was slowly convinced this was different. Colonel Edward House, Wilson's closest advisor, worked behind the scenes to persuade him. The argument was simple. This wasn't banker control. This was government regulation of bankers. The Federal Reserve would prevent the kind of Wall Street dominance that caused 1907. Wilson bought it. The actual structure barely changed from Jekyll Island. 12 regional banks, check. Central coordination, check. Elastic currency through bond purchases, check. Member banks own stock and collect dividends, check. The only real difference was the Board of Governors would be presidential appointees instead of banker-elected. But the regional banks, where the actual power and profit sat, remained banker-controlled. Glass and Owen pushed the legislation through Congress in 1913. The timing was perfect. December 23, 1913, right before Christmas, when most congressmen had already left Washington. The vote happened quickly. Limited debate. Wilson signed it that same day. The Federal Reserve System was law. Here's the beautiful irony. Wilson thought he was preventing banker control of money. Glass thought he was creating government oversight of finance. What they actually did was give legal authority to the exact system that Warburg and the Jekyll Island crew had designed. The bankers got everything they wanted. Regional banks they controlled, the ability to create money and collect interest on government bonds, a permanent seat at the table of American monetary policy. And they got it all while making politicians think they'd won. The question wasn't whether America got played. The question was whether what they created would actually work. And the answer would reveal itself in the most catastrophic way possible. So what exactly did they create? The Federal Reserve System isn't federal, and it has no reserves. Let me explain what that means. The Federal Reserve is structured in 3 layers. At the top, the Board of Governors in Washington. 7 people appointed by the President. This is the government part. In the middle, the Federal Open Market Committee, which decides monetary policy. 12 voting members mixing governors and regional bank presidents. At the bottom, 12 regional Federal Reserve banks scattered across the country. And here's the key part. Those regional banks are owned by private member banks. If you're a bank operating in the Boston Federal Reserve District, you're required to buy stock in the Boston Fed. You literally own shares. Those shares pay dividends, currently fixed at 6% annually. The Federal Reserve makes profit by holding government bonds and collecting interest. In 2023, the Fed made $170 billion in interest income. After expenses, it returns most profit to the Treasury. But member banks get their 6% dividend first. It's a guaranteed return backed by the government's ability to print money. The Fed's actual power comes from controlling the money supply. Here's how it works. When the Fed wants to increase money in circulation, it buys government bonds from banks. It pays for those bonds by creating new money electronically. The bank gets cash, the Fed gets bonds. That new money flows into the economy through loans and spending. When the Fed wants to decrease money supply, it sells bonds back to banks. Banks pay with cash. That cash disappears from circulation. This is how the Fed expands and contracts the money supply without physically printing bills. The Fed also sets interest rates. The federal funds rate determines how much banks charge each other for overnight loans. When the Fed raises this rate, borrowing becomes more expensive throughout the economy. Mortgages cost more. Business loans cost more. Credit card rates go up. When the Fed lowers rates, borrowing gets cheaper, and the economy typically grows faster. This is the lever they pull to speed up or slow down economic activity. World War I gave the Fed its first major test. The government needed to finance the war. Between 1917 and 1918, the Fed helped the Treasury sell billions in war bonds by keeping interest rates low. This made borrowing cheap for the government, but it also flooded the economy with money. Inflation spiked to 18% by 1918. The purchasing power of a dollar dropped by nearly half during the war years. The Fed had successfully financed the war, but it had also demonstrated the fundamental tension in its mission. Low rates help government and banks, but they destroy the value of ordinary people's savings through inflation. Through the 1920s, the Fed kept rates low. Credit was cheap. Banks lent freely. The stock market soared. Everyone believed the Fed had solved the business cycle. Boom and bust was over. Panics were history. Modern monetary management had created permanent prosperity. Benjamin Strong, who'd been at Jekyll Island and now ran the New York Federal Reserve, was celebrated as a genius. The system worked perfectly, until it didn't. And when it failed bigger than anything America had ever seen. October 1929, the stock market crashes, loses 89% of its value by 1932. 9,000 banks fail. Unemployment hits 25%. The Great Depression destroys a decade of American prosperity. And the Federal Reserve, the institution created specifically to prevent panics, makes everything worse. Here's what the Fed did wrong. Benjamin Strong died in 1928. Without his leadership, the Fed fragmented. Regional banks disagreed about policy. In 1930, as banks were collapsing, the Fed raised interest rates. They wanted to defend the dollar's gold value. Higher rates meant tighter money, exactly when the economy needed liquidity. Banks that might have survived with Fed support instead failed. The Fed was supposed to be the lender of last resort. It refused. Between 1930 and 1933, a third of American banks disappeared. The Fed watched it happen. This wasn't incompetence, it was ideology. Fed officials believed failing banks deserved to fail. They thought the Depression was purging speculation from the system, a healthy correction. They were wrong. By 1933, the financial system had collapsed so completely that Franklin Roosevelt closed every bank in America for a week. The Fed, created to prevent exactly this catastrophe, had instead presided over the worst economic disaster in American history. But the Fed survived. Roosevelt took America off the gold standard domestically in 1933. This freed the Fed from gold constraints. It could now expand the money supply without worrying about gold reserves. By 1971, Nixon ended gold backing internationally. The dollar became pure fiat currency, its value based entirely on trust in the government and Fed management. The constraints the Jekyll Island designers had worked within were gone. The Fed could now create unlimited money. Fast forward to 2008, the financial system collapses again. Banks over-leveraged on mortgage-backed securities. Lehman Brothers fails. Credit markets freeze. The Fed's response: create money on a scale that would have been unimaginable in 1913. Between 2008 and 2014, the Fed printed $3.7 trillion through quantitative easing. Bloomberg revealed the Fed secretly lent another $16 trillion to banks during the crisis. Those loans were hidden from Congress and the public until Bloomberg sued to get the records. Then came 2020. COVID hits. The economy shuts down. The Fed's response makes 2008 look restrained. In 2 years, the Fed creates $4.5 trillion in new money. Its balance sheet explodes from $4 trillion to $9 trillion. Asset prices soar. Stocks hit record highs. Real estate becomes unaffordable, but wages barely move. The Fed successfully prevented a financial collapse. It also created the largest wealth transfer to asset owners in American history. Here's the pattern. Every crisis, the Fed prints money. That money flows to banks and financial institutions first. They buy assets before prices rise. By the time money reaches ordinary people through wages, asset prices have already inflated. The Cantillon effect that Warburg understood in 1910 is still operating. People closest to money creation benefit most. Since 1913, the dollar has lost 96% of its purchasing power. The wealthiest 10% of Americans now own 67% of all wealth. In 1913, they owned 45%. The system is working exactly as designed. But designed for whom? Let's answer the question that matters. Did that secret meeting on Jekyll Island in 1910 save America or enslave it? The honest answer is neither, and both. The Federal Reserve was created to prevent banking panics, provide elastic currency, and stabilize the financial system. How did it do? Banking panics still happen. 1929, 2008, 2020, they're just called different names now. Financial crises, liquidity crunches, systemic risks. The Fed provides elastic currency, but that elasticity has destroyed 96% of the dollar's value since 1913. $1 in 1913 could buy what $27 buys today. The Fed created stability for banks. They no longer fail during panics because the Fed bails them out. But that stability came at a cost. Your money steadily loses value while banks collect guaranteed profits. What if America had no Federal Reserve? Look at the evidence. From 1790 to 1913, America had no central bank for most of that period. The economy grew faster than any other nation in history. Banking panics happened every 20 years, but they resolved quickly without government intervention. Would 2008 have been worse without the Fed? Possibly. Failing banks would have destroyed more wealth short-term, but without Fed bailouts, banks might not have taken the risks that caused 2008 in the first place. The Fed's existence encourages recklessness because banks know they'll be rescued. Here's what's undeniable. The bankers who met at Jekyll Island designed a system that benefits bankers. Member banks own the regional Feds. They collect guaranteed dividends. They get cheap loans during crises. They're protected from failure. Meanwhile, the Fed's money creation consistently inflates asset prices faster than wages. If you own stocks and real estate, Fed policy makes you richer. If you work for wages, Fed policy makes your money worth less every year. Since 2008, the Fed has printed over $10 trillion. The wealthiest Americans have gotten measurably richer. Median wage earners can't afford houses their parents easily bought, but eliminating the Fed tomorrow would cause chaos. The entire financial system is built around it. Government debt depends on Fed bond purchases. Banks depend on Fed overnight lending. Markets depend on Fed interest rate guidance. Ripping it out would be like removing the engine from a car going 70 miles an hour. You'd crash. So what do? You understand how the system actually works. That 1910 meeting created a structure that benefits people who own assets over people who own only their labor. Your dollars in savings lose value by design. Inflation isn't a bug, it's a feature. It transfers wealth from cash holders to asset holders. The solution isn't revolution, it's adaptation. Hold assets, not just cash. Understand that every Fed decision affects your purchasing power. Know that the people setting monetary policy come from and return to the banking industry they regulate. Paul Warburg, Nelson Aldrich, and those 5 other men who rode that train to Jekyll Island weren't villains. They weren't saviors either. They were bankers who designed a banking system. It works exactly as they intended. It prevents complete financial collapse while steadily transferring wealth to people who already have it. That's not conspiracy. That's just how the machine works. And now you know who built it.